The major stock markets in New York are currently closed, and as of the final bell on June 17, 2026 at 4 p.m. Eastern Standard Time, Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, finished the official session at exactly $0.40, representing a modest intraday gain of 4.17% from its prior baseline. While a 40-cent penny stock usually suggests a company struggling for relevance in a forgotten corner of the public markets, the hidden narrative driving this ticker right now involves a staggering $2 billion structured financing term sheet and a massive asset tokenization portfolio that almost nobody in the retail trading community is talking about. Retail players looking for high-octane growth tend to load up their self-investing accounts with mainstream megacaps, keeping their eyes glued to the daily swings of Tesla stock or checking their mobile alerts for Apple stock movements. Yet while the broader crowd debates whether to buy fractional shares of a traditional semiconductor giant, a low-profile entity like this is quietly assembling a portfolio of over 100 patents centered on tokenized minting and blockchain authentication. The core tension in this asset lies between the retail market expectation of a distressed sub-dollar corporate restructure and the complex operational reality of a business that is trying to become an institutional infrastructure player for real-world asset tracking. When individual investors log on to popular investing sites or scroll through their retail portfolios, the general consensus on any stock trading under 50 cents is that it represents an extreme, near-bankruptcy gamble with very little structural support. It is incredibly easy to glance at a multi-year downward chart and assume that a business has run out of options, especially when the historical numbers show significant net losses and a balance sheet burdened by rapid capital expansion. However, the contrarian view that forces a complete rethink of this narrative is the sheer scale of the commercial contracts the company has claimed to sign behind the scenes, including a massive global tokenization mandate and tens of millions of dollars in associated fees reported during the first quarter of this year. To get a clear view of how this asset behaves, you have to look past the superficial social media chatter and study the extreme trading volumes that routinely flood this ticker, where daily trading velocity regularly exceeds tens of millions of shares in a single session. This massive liquidity rotation indicates that institutional microcap desks and high-frequency algorithms are actively battling over these shares, using advanced platforms like the Interactive Brokers platform to position themselves around sudden regulatory changes and legal filings. If you're managing your capital through a traditional individual brokerage or exploring automated allocation tools like Schwab Intelligent Portfolios, discovering a tiny microcap with institutional-scale patent filings represents a complete shift from the usual blue-chip strategy. To truly understand the recent price mechanics of this company, we have to look closely at the trading tape from the last few weeks, which has seen the asset bounce heavily off its critical support floor near 25 cents, after enduring a brutal 40% drop earlier in the month. This severe downward pressure was sparked by intense market skepticism surrounding a major corporate financing headline on June 1st, where the market began to demand hard evidence that the capital injections were actually hitting the bank accounts. Retail traders utilizing the Robinhood stock trading app or executing active strategies on the SoFi trading platform often get caught up in the initial excitement of a multi-billion-dollar framework agreement without waiting to see if the binding terms are fully executed. In this specific case, the market became highly reactive because a non-refundable $25 million payment that was supposedly due in early June lacked an immediate explicit confirmation filing on the regulatory server. This lack of visible confirmation caused shorter-term momentum capital to flee the stock, driving the price down to historical lows before a wave of high-volume accumulation finally showed up to defend the underlying double-bottom chart structure. Comment below how many shares of Datavault AI Inc. you currently hold in your portfolio right now, or if you prefer sticking entirely to large-cap technology equities. This persistent battle between raw price action and corporate announcements is precisely why investors need sophisticated investment help when navigating the microcap environment, as the risk profiles are fundamentally different from holding diversified funds like Fidelity ETFs or established core assets inside long-term Fidelity IRAs. When you look at the raw financial performance from the first quarter of 26, the data reveals a massive conflict between exponential top-line growth and collapsing operational efficiency. The company reported a spectacular 443% year-over-year surge in revenue, which sounds incredibly bullish on paper and easily captures the attention of anyone looking to invest online. But the underlying reality is that this revenue print actually missed the broader consensus estimates by a massive 83%, while gross margins compressed down to a meager 3% compared to 11% in the same period a year earlier. This margin collapse indicates that the cost of delivering its specialized technology services and scaling its distributed edge network is currently eating up almost every dollar coming through the front door, leaving the business with an operating loss of nearly $31 million for the quarter. For an investor managing an active account through a specialized system like Interactive Brokers stock trading, these structural metrics force a vital question about whether the underlying corporate model can achieve true sustainability before its remaining cash reserves are entirely depleted. The corporate entity itself operates across two distinct segments, managing an acoustic science division alongside its primary data science and asset tokenization ecosystem. Originally known to the public markets as WISA Technologies before completing a comprehensive corporate rebranding in February of 25, the company has legacy roots in high-performance wireless audio technologies, licensing proprietary systems that enable high high-fidelity sound transmission for home entertainment without complex wiring. While that historical audio business still exists and has recently explored a standalone public dividend spinout, the modern valuation of the stock is almost entirely tied to its newer cloud-based platform designed for data management, valuation, and secure monetization within decentralized environments. They are trying to position their technology as a standard for cyber risk mitigation and real-world asset tracking, signing promotional deals with international figures and expanding partnerships to create blockchain-driven healthcare infrastructure. When you evaluate this operational footprint against traditional investment benchmarks, the financial contrast becomes even more dramatic. On one hand, you have a business model that is heavily reliant on continuous capital raises, as evidenced by a recently closed $60 million public offering of common stock that significantly diluted existing shareholders, but provided a critical capital runway. On the other hand, the company is actively securing valuable intellectual property, including a recent notice of allowance from the United States Patent and Trademark Office for a comprehensive system governing tokenized minting, authentication, and asset utilization. This growing patent portfolio is what underpins their claims of massive long-term contracts, creating a massive curiosity loop for anyone analyzing the stock through modern online investing portals. If these multi-million-dollar fee structures turn out to be fully binding and collectible, the current sub-dollar share price will look like an absurd market mispricing. If they turn out to be speculative frameworks that fail to materialize as cold cash, the massive operational cash burn will continue to weigh heavily on the equity. Navigating these highly speculative waters requires a level of platform execution that retail traders often overlook, which is why choosing the right financial partner matters so much. Traders tracking this asset on the Robinhood app often focus purely on the extreme daily volatility, trying to scalp quick percentage gains on intraday swings without considering the long-term balance sheet implications. Meanwhile, more conservative capital market participants tend to utilize established platforms like Fidelity Investments, or manage their wealth through specialized services like Fidelity Wealth Management, where the focus is naturally steered towards sustainable cash flows, historical returns, and institutional-grade assets like Fidelity mutual funds. The reality is that microcaps with heavy patent portfolios and complex financing agreements rarely fit into a standard long-term retirement strategy, making them highly specialized trading instruments rather than stable buy and hold options. Whether you execute your trades through a basic Fidelity brokerage account, utilize the advanced features of the Fidelity mobile app, or run automated models via a SoFi robo-advisor, managing a position in a stock like this requires constant monitoring of regulatory filings and institutional block trades. Looking ahead, the future outlook for this company depends entirely on whether reality can finally catch up to the massive expectations established by management's ambitious press releases. The primary catalyst to watch over the coming months is the explicit confirmation of cash receipts from their reported $2 billion structured financing agreement and the verification of ongoing fee generation from their global tokenization contracts. If the company successfully files clear financial documentation showing that substantial capital is flowing into their cash management systems, it will validate their business model and likely trigger a massive short covering rally as institutional short sellers are forced to buy back shares. Additionally, any progress regarding the dividend spin-out of their acoustic sciences division could unlock hidden asset value for correct shareholders, giving them direct equity in a standalone public audio company while retaining their exposure to the core data monetization business. Conversely, the risks remain exceptionally steep, as any further delay in capital execution or continued compression of their gross margins will force the company to look for additional dilutive equity offerings, putting further downward pressure on the stock price. When you analyze this asset from a high-level perspective, the central insight is that the market has priced the stock based on its worst-case financial realities, while ignoring the massive potential scale of its intellectual property portfolio. It represents a classic example of the psychological tension that defines modern technology investing, where the visible financial distress of the present completely overshadows the structural possibilities of the future. For traders utilizing advanced execution tools like interactive brokers trading, or managing their personal capital through a self-directed individual brokerage, this stock demands a rigorous approach to position sizing and risk management. It is an asset where the traditional rules of blue-chip valuations simply do not apply, and where success depends entirely on reading the underlying corporate tape rather than following the retail crowd. By maintaining a clear-eyed focus on actual capital inflows and ignoring the speculative noise, investors can map out the precise milestones that will determine whether this microcap can successfully transform its business or remain trapped in the volatile world of sub-dollar penny stocks. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Best of luck, best of the day. Don't forget to like, comment, and share this video to support the channel.